after the March meeting that substantially higher tariffs were likely, and then since
we
then,
are live.
The estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time, and what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say.
There we go. So nothing extremely hawkish.
It's actually a line from the Teal book, which you can see in 5 years. Remember to check that. No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. That's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber, Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. Received some housing data, including this morning, that have been pretty weak.
What's up, Travis?
Any concerns that the economy is weakening and that is a reason to cut rates?
Let me hold on.
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing.
Update the title here.
It's hard to know.
Get some more views.
Unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still.
Well, you know what starts now, guys?
So,
the next FOMC meeting.
You can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of, basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario?
Really hanging on by a string here, kind of, but I think we can come up more.
The conversation we had today and yesterday. There are many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate, and it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast
and or growth or the unemployment rate, how many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's again, it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see whether, to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point it will become clear. I can't tell you exactly when that will be. And, meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But, the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer, and each one
How'd I
of
learn
those
to
is
trade?
trying not to be the one to
A lot of different things, man. A lot of different ways. Yeah, Jason Casper's course I've gone through some years ago is pretty good. Really good. Crypto Face, watching a lot of live streams, and some other people, a lot of the other TA guys, just a lot of combination of things, and I kind of do things my own way now. We'll see what the hell happens here. I mean, a little more hawkish than I expected, but not that bad. I don't know.
Nick Tamarosa, the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down
There we go.
cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook, or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts. And they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things, and I think as the data come in, you should see those differences diminish.
If I could follow up,
I mean, paper trading you could do. There's breakout also. If you can get the passive valuation, you could do small amounts as well. I've done all of the above. So yeah, all of the above is the answer, I would say. I would do paper trading until you are comfortable using the damn exchange. Some people don't even know how to use the damn exchange. So You know, I'd have minimum paper
That's
trade
what you would say,
until
but
that, and
that's
then
not-
do low
we have to
amounts.
be
That would make the most
forward-looking,
sense.
and the thing that
Never bet
every
more than you're
investor,
comfortable
every
losing on
outside
any particular trade. That would be the biggest
and the
advice
Fed
I would
is
give.
saying is that we expect a meaningful amount of inflation.
We're dumping though, so I guess.
And we have to take
Maybe
that
this
into
is the
account.
damn
So,
start of a summer
you know,
lull. That's gonna
backward-looking
suck if it
would
is though.
lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
I would still think you should be able to hold here. It's been a boring fucking month, I'll tell you that much.
Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction. And I'm wondering, now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
Okay. From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
I was like, F you.
Thanks, Mr. Chairman. I guess with workplace
Yeah, just cut that guy off a little bit.
increasing, picking up significantly, what kind of effect would that have on the labor market in
Sorry,
the short
with
term?
what picking up?
Workplace raids.
So you're asking immigration?
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SCP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into
Trading with small amounts of
Pardon me,
capital
to
is pretty
discussions
similar to
about
paper trading, I would say.
specific changes to language. So that's
You don't want there to be emotion in any trade, bro.
The second
There's
part
too
of it is
much
our
emotion. You're
communications
risking
tools
way too
and
much.
practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SCP is part of it. Many other ideas. It's sort of, how do we think our communications can be improved?
Hey, this
There are
is like a
number of
typical
ideas
double
people
top right here,
really-
lower high.
It was a great conversation. Number of ideas.
This should
We're
come
gonna
down.
look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also, you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're gonna be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Well, the forecast.
That's a good question. Yeah.
In December was 2.5%. Core PCE for 2025. The forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be. We've learned that tariffs are going to be substantially
wrecked
larger
here.
than
Jeez.
forecasters generally thought. And we don't, our forecasts are generally not particularly different from those of other, well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming, and that would mean higher inflation. That's what happened. So you saw 2.5% forecast in December. You saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans. Small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, we're trying to restore price. Best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we could start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now. And inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. every forecaster you can name who is a professional, forecaster with adequate resources and forecasts for a living is forecasting pretty significant, everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs, because someone has to pay for the tariffs. And it will be someone in that chain that I mentioned, between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind, or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately, the cost of the tariff has to be paid. And some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
Follow up on that. So you spent years ago talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking at, I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right? So it's always forward-looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking, because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through
jump
this,
here, I mean.
and they understand how they're going
Higher
to
low.
It feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Oh.
Thank you. I'm Mara Mokway with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no. And I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we do. We work hard. But I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're gonna show the public. We're gonna demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're gonna find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it again respecting that we have critical missions to carry out. I've had experience, a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions. And I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it. at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so, we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous. And so we actually, really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and the effects will be at the margin. I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks, and worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see, layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy. And
probably won't work for.
It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place to. I would want to keep investing in that, for the good of the general public.
Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that a new chair might want to come in and go in a completely different direction. I really don't think that's right. But but that's not going to be up to me to decide.
Is that affecting at all who you're consulting with?
Not at all. Not in any way.
Yeah, he doesn't want to talk about that, obviously.
Thank you.
This is probably
Chair
almost over.
Powell, from CNN. relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis.
The
in
hell is
Middle East.
Karen Reed?
How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation, and what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that.
This, there's a
You know,
brand new book.
possible that
This is a real game change.
Been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. Question really is, will AI be more augmenting labor or replacing
I
labor?
don't understand
And I
what the
wouldn't,
hell he's
we all see those announcements, including one today. I wouldn't, overread a couple of data points, because, AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with AI will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Yeah, that's kind of.
Thank you. Greg Robb from Market Watch. I was wondering if you could step back a little bit, Chair Powell. There's
We're jumping.
a spate of articles and a lot of op-eds now in the newspapers
There we go.
saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the dollar movement, so the dollar was impacting the economy. Are we going through something like that now? That, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint, you see this not just here but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. But and it doesn't change our objectives or what we need to do. And these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know though. So, but you're right. But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Yeah, hopefully this is almost over. This is pretty damn boring.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. At the margin, remember, you're at 4.2% unemployment. That was, for many years, that was an extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is there are not a lot of layoffs, but there are not a lot of job creation. If you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very, very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S. economy has defied all kinds of forecasts for it to weaken really over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
Hi, Chair Powell, Jean Young with M&I Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So, I think, people are writing down their most likely path, right? They're not
believes crypto on a while ago.
Really,
Good guy.
Think of it as the least unlikely.
Hope you know what believes.
In a situation like this where uncertainty is very high.
Yeah.
I think, again, people write down their rate paths.
Yeah, I would agree with that. I mean, not extreme, kind of middle ground, Typical boring Jerome.
They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence. So I would just say it that way. We don't rule things in or out.
Lose where we are right now, kind of just taking the, more careful path and, saying, F you, Trump, I'm, not listening to you. But the betting odds are normally the best thing to look at, when it comes to, what's the market going to do and all that, what they're going to do with the rate cuts. Now, when we get into here right now, there's a few different, so 2 scenarios. One, our summer lull is starting now, and you eventually lose this, and then you drop down. I mean, our high was around there. I would say 25 is probably enough. It could be 30. Maybe you drop down to 2,000 again or something in July and August. And then from there, then kind of into your end of year, maybe a little bit earlier, you can hopefully make a new all-time high or something. That's your more bearish scenario. Your more bullish scenario, and every day that passes, I think it gets slightly less likely, would be bullish into early July. Then you have your summer lull, and then into the end of the year, early next year, you make those new all-time highs or whatnot. But yeah, I'm just trying to think here. I mean, man, do we jump here? You probably got a good shot, especially with that monthly. That's where it gets so much more bullish, because you wipe away all the noise and whatnot. You look at that monthly. I mean, you can't argue too much with the monthly trigger wave. Now, it's possible when this confirms, sometimes it's already played out, and then you come down, and it plays out more into the end of the year. But more likely than not, it should keep going based on that. And then you have the Bitcoin monthly green dot as well. So generally, I mean, you could be asking for a lot because the damn thing's been up so much, but generally, you should be able to keep going. You know what I mean? So yeah, there's that possibility. Oh man, I'm trying to think here. So yeah, been a gloomy few days where I am. Finally getting sunny again, so I'll take it. So yeah, but you know, a little bit of sunniness, high 70s, we'll take it. We'll take it. Anyway, man, I'm just thinking here. Already like 324. Yeah, Travis, you're probably definitely right about some things there. You know, there shouldn't be that much emotion in trading. Like a Lady Trader Raw or whatever on Twitter says, I forget the exact username, but you know, she was saying, what was it? You got to be like a robot, and I think that's generally pretty true. But I mean, the main thing right now, and you know, anybody with some basic technical analysis skills could tell you something of this nature, you know, for a trade is a decent bet. You know, you could go 2-to-1 like that. Decent bet right there. Could play out differently. Now you're coming back down. You know, he's done speaking. I don't know. I mean, I'm still kind of in the park. I mean, this is bearish in your 3-day, but I mean, I'm still in the park that your bullish things should be able to play out, but be careful. You know, it does look like, you could roll over here, you know. The freaking Middle East stuff kind of screwed us up too, but that's, you know, that's always going to happen once in a while. So yeah. Here's what changed. Let's see. Employment rate remains low. I don't know. Diminished remains. Okay. That's, I mean, this kind of summarizes everything here. I mean, okay, these names, but slightly less, more or less slightly less hawkish than last time. That's what you would interpret from that. Slightly less hawkish than last time. And yeah, I mean, is what it is. Nothing that nobody wouldn't have been able to guess. This is a very expected meeting. You know, you just kind of focus on your. I mean, it's kind of boring every meeting unless they actually move something. You know, if you're not moving rates, you know, it's kind of useless. You know, you just the way he answers questions is kind of, you know, there's not much to say. You know, it's just like nothing's changed. You know, but yeah, so you know, there's the outlook, and then September still could be a pause theoretically. It probably will be a cut, I would guess. And then you have October, which would be a pause in December. So, I mean, and then when you look, your outlook, well, I mean, okay, so they're really thinking there's going to be some cuts. Oh, okay, so that would be, yeah, we're already at, okay, so that's a pause for January. This gets speculative, but that's a cut in March. It's still a pause for June. It's a cut in July. Is that a pause for, yeah, this is just purely, I mean, nobody knows what the hell, but okay, so a couple cuts into, so you're looking at in the next, you know, over a year, next freaking year and a half, you're looking at 4 to 5 cuts, 5 grass cuts, cut your grass. No, I'm just kidding. But yeah, that's kind of what you're looking at potentially in that amount of time. But no, it's look, I mean, it's just the factor. I think we're with the bond market. It's just, you know, you look at the TLT, and yeah, kind of like that is where we may be right now. You know, they kind of double bottom or something. So you got a little bit. You know, you might got. My God, what am I? I sound like I'm in a freaking. But here, you know, a couple more years of choppiness. I don't think you're going to see anything too significant with this anytime soon, unfortunately. Rates probably will remain somewhat high for a while. What's up, Mark? 30-year mortgage rates, you'd be lucky to get down to like 6.3, 6.2 end of year. Something like that's what I would guess. Nothing too significant. Man, I'm just trying to think what else here. How about real estate? Because I was looking at real estate's been a little Florida, you know, when you look at listings and stuff, there's a lot of shit on the market, but then when you look at the chart, it just keeps going up, so I don't know. And in case Schiller, you know, the basis has remained that real estate should get your typical 5% for the next few years, then peak out, you know. I mean, if you were to do something of this nature, actually, yeah, if you were to pray like that, 27, 28, maybe some sidewaysness, and then starts to dump. And well, that would fit with a 4-year cycle, something like that. If you peak out into 27, you sideways for 2 years, and then you start dumping down. That would make sense. And then your bottom is in, I don't know when the hell's I mean, that's a weight right there, but your bottom is in the early 30s. Probably back down to, just count 1, 2, probably back down to around here or something. I mean, you know, you could, that was back to 03. Like, how many years were erased? Erased like 3 years there. So 27 to 24. Yeah, right there, I would argue. And that's, what kind of percentage drop is that? That's a 30%er. So, yeah. Trying to think here. Thinking here. So yeah, I mean, just trying to wait and see what the hell happens. I mean, this market is equally as boring as Powell was. I mean, not much really going on. Are any alts moving? There is no we. What kind of question? What a stupid question. No, I'm just kidding, man. I just love that quote. What a stupid question, but I know you. You ask a lot of stupid questions. It's like an angry Italian man or something. Anyway, I don't know. I think trying to long is the best choice right now, but it could, your summer low could be starting earlier. It's hard to say at the moment. You just ain't, you know, you getting your red hiking ashy here. Get your red hiking ashies. Man. So, yeah. In all likelihood, this should be a trend reversal upward. You know, it should be more like that in all likelihood. But, yeah. QT is obviously still going on. Yeah, no QT. That's probably not getting until September. So 2 more meetings. I think you got one in, was it July, and then there's none in August, then September. So there you go. Let's see here. So it's Cardano. That's been lagging. I wanted to look at, let's see, Cardano ETH right now. Yeah, that's really been. Was hoping that would come back a little bit, but no. CRO is up a tiny bit, but it's still, yeah. It just isn't what. Well, that jump there could be some hope. We'll see. And then get your ape coins. Get your ape coin. Right there. We'll see what the hell happens with that. Trying to fight back a little bit, but these trigger waves, I don't know if I like them too much. Anyway. I don't know if there's really too much else to talk about. I mean, it's going to be the same thing. Like, I think the main prospectus is you still got some hope to... Yeah, look, the main thing that I'll reiterate here, guys, is one of 2 things is going to happen. You're either going to break downward on ETH to, you know, somewhere between 2,000 and 2,100. Or you're going to break upward, you know, somewhere between 3,000 to 3,200. That should happen any day. You know, hopefully end of month, early July would be the absolute latest I would see. It'd be surprising if you stay boring for that much longer than that. Same thing for Bitcoin. Now, when you look at your damn monthly on ETH, trigger wave forming and all that, that would give your case for the bull case. You know, And these money flows are not terrible. So I would still be in the bull case so long as you can confirm here or hold where we are right now. Similar thing for Bitcoin. I feel like Bitcoin looks slightly more bearish, but that could be a good sign for Bitcoin, for ETH versus Bitcoin, which are in this scenario where ETH is supposed to, jump upward of this somewhat of a reverse head and shoulders and, continue to outperform Bitcoin here. So that's what I'm hoping for. We're either going up and down. No, that's not true, Matt Ford. We could go sideways. I'm just kidding, man. We go kangaroo sideways. So yeah. No, I mean, it's kind of like, people get mad, if you're too deterministic and you get it wrong. People get mad if you're not deterministic enough and you say you don't know. Obviously, I encourage everyone to read the book, Trading in the Zone by Mark Douglas. I'm sure the guy's dead. I'm sure you could pirate it. I'm not paid to promote it, but, the main idea is that we don't know what's going to happen and we don't really need to know. We don't need to know what's going to happen to make money. It's all a game of probability. You just got to have that edge. There's a lot of similarities between, this and counting cards and blackjack. It's all about strategy. It looks like we're coming up, though. Sorry about the mouse thing. Maybe we'll change the mic or something. Oh, yeah, I wanted to get a freaking... Yeah, I could probably get a mount for the mic I had, and then I just need an interface here, but I don't know if I want to do that. I don't know. Anyway, Could lose the only thing out for me. Yeah, I mean, you guys, for learning, I would say, some of the exchanges let you do paper trading. I know BitGet used to, but, yeah, I don't affiliate with them anymore, but, because it's KYC now. They were a good exchange, though, if it's KYC, but I don't know if they still do that. I'm slightly more bullish in the short term, man. Obviously, I don't know. What do you ask? ETH and Bitcoin look better than everything else. I'll say that. You know what I mean? For the short term, I think you got a good shot of jumping up. If you look at, I'm not the biggest proponent of these, not the biggest, some people really, trade 100% of it. I would not be trading based on this. But there's more liquidations. I usually look at the minimum, the 3-day. But, now it's changed. But, well... Yeah, this is going to tell you whatever the hell you want if you look at enough time frames. But it seems like there's a bit more liquidations, and it probably will liquidate both. You could go down and then shoot up or whatever. Probably liquidate everyone. But there's more liquidations upward. There's a lot of people trying to short the top. They were trying to short the top there, so maybe they'll get railed. If you do go into a bad summer lull, it's not impossible. These points get hit. So, bottom line, your market maker is going to make money regardless if it goes up or goes down. But yeah. Let's actually look at, can I do it for ETH? Yeah, let's see. I'll look at that for ETH if there's any differences here. Yeah, a lot of people are betting you won't go under 1900. That makes me worried. I don't know. Yeah, you could, if you look at enough stuff, you could have this tell you anything you want. There's probably been a lot of recent longs opened, but more people, if you look overall at funding rates, these are healthy funding rates. There's not that many more people going along at the moment. You know what I mean? Alts, I would be very careful with at the moment. I think your more money is... I think it's ETH season. I think that's the best bet. And I think anybody who knows... the TA is going to tell you that. Anyone who knows good TA will tell you that ETH is the best bet right now. And if you're looking at fundamentals, okay, maybe Bitcoin because of monetary policy. But ETH is really, based on technicals, the best bet. You know, what's the market cap of ETH? 300 bill. I mean, you would hope 600 bill at least, you know, end of year, new all-time high. Yeah, that's what you'd hope for. So, yeah. Anyway, I think I'm probably going to get off. There's not too much else to talk about at the moment. I wanted to go for a little run or something. It's nice out right now. I'm just thinking. Just thinking here. Yeah, I don't know what else to. Yeah, there's not much else to talk about. I think we should be okay. I think we should jump up more. I would get a little bit more concerned early July. Maybe your summer low is going to be in August, though. We could have a good July, and then your August is more your summer low. We just don't know exactly what month. More of the prices, ETH at 3,200 would be likely the final rejection, in Bitcoin at 120. Now, if we map this out, you got until 4th of, it's funny how exactly like 5th, 4th of July, until then you would get more bearish, in my opinion. So we'll see. I mean, I don't know. Trying to sell now for your summer lull. I mean, I wouldn't advise, you know, well, not financial advice, but for someone trying to hold on to the end of the year, I don't know if this is really the best point to take profits, but, you know, double top situation, you know, your summer low probably will end up lower than where we are right now. So that's what you would look at there. But yeah. Anyway, guys, I'm going to get going. Special like button, subscribe to the channel. Oh, I forgot to mention, got some good promos for, they're in the chat, not the chat, I didn't even post it in the chat. They're in the description. BloFin and BYDFI. You get 10% for fees for life with both of those if you sign up with my link. In addition, remember, if you deposit at least $100 on either of those, I'll give you 1 free month in Aldo Empire VIP Discord. A lot of really good trades there, including this losing one right now. No, I'm just kidding. Not every trade is going to be a winner, but this could come back. This is a big freaking position. This is a 130K position. That's a big position. So, I mean, being 1,000 down isn't terrible on that right now. But anyway, guys, I'll see you guys real soon. Subscribe to the channel. Hope you have a